Hello, Mark and Lauren. Thank you for coming in and meeting with me today to review the comprehensive financial plan which I have prepared for you. I know that we have exchanged many calls and emails recently to gather all the necessary information. I know it's not easy gathering various statements and documents, and I certainly want to thank you both for your efforts and your patience thus far. Also, your honesty and openness into sharing these various detailed aspects of your life certainly makes my job as your financial planner easier and enables me to present the most suitable options and recommendations available to you. You both have done an excellent job of saving and accumulating a great deal of wealth, and we want to ensure that your wealth is managed prudently and efficiently for not only your lifetime, but for your children and their children as well. I've customized this financial plan and tailored my recommendations to you based on your needs, goals, and objectives. And a financial plan is only helpful if action is taken. So to be fully successful, it will take a team effort. We'll need to rely on your accountant, your estate planning attorney, and other knowledgeable professionals to implement the necessary recommendations. We will then want to monitor their plan over time as your financial and family circumstances may change. I know you both have had a chance to review the financial plan I'm presenting to you today. I strongly encourage that if you have any questions, comments, or concerns regarding anything we discuss, please do not hesitate to ask or comment. Again, this plan is tailored to you, and I want to ensure everyone has a clear understanding. I would first like to start by addressing one of your main goals, which is the plan to secure the funding for Mary's private college education at an Ivy League school. And there are various options to save for higher education, which include Coverdell Education Savings Accounts, 529 plans, and also UTMA accounts. Based on your circumstances, my recommendation to you is to fund Mary's education with the 529 plan. The main objective of the 529 savings plan is that there are no income limitations for contributions. Also, these contributions and subsequent earnings grow tax-free and can be withdrawn tax-free as long as they're used for qualified education expenses. Another advantage of the 529 is that you as the custodian maintain control of the account. Unlike other plans, which you may lose control of once the child reaches the age of majority, 529s can also be a valuable tax planning strategy due to the fact that these plans are not included in your gross estate. Mary begins college in 13 years, and given the fact that she will need $40,000 a year for tuition and education expenses in today's dollars, and assuming a 7% yearly increase with a 10% average annual rate of return, it will cost approximately $540,000. And you can take two approaches in funding Mary's 529. The first is to make annual contributions, and the second is to fund with a lump sum contribution. So as you may have already experienced with your other two children, the cost of college education is rapidly increasing. In 13 years, it will cost approximately $96,000 for Mary's annual tuition. And you should take the annual payment approach, and you could take the annual payment approach and contribute about $20,000 a year for the next 13 years, and this would enable you to take advantage of the annual gift exclusion and successfully meet Mary's future education needs. The second approach to funding the $540,000 cost of Mary's higher education is, instead of making contributions annually, is to make a lump sum contribution of $156,000 now to enable the assets to grow and meet the required future cost. And to come up with this lump sum, you could pre-fund the 529 with 5 years of joint contributions. That's at $28,000 annually for a total of $140,000. And then use the funds from either savings, the proceeds of your business sale, a gift from Portia or Beverly, or a combination of any of these to get the additional $16,000 to meet that $156,000 lump sum total, which will grow to $540,000 given our assumptions in the necessary funding. This can also tie into your other goal of assisting with the college education funding for Beverly's two children. I would also recommend that 529s be established for each of her children, which you and Beverly could fund at a rate you see fit. You can certainly discuss the funding of their 529s in more detail once we have a better idea of what type of schools her children might attend. Lauren, I know you in one of our initial conversations asked about using the Coverdell education savings account to fund your grandchildren's education. However, there are income limitations to this type of account, and you would only be able to contribute $2,000 annually. You then also asked me about the UTMA account or UGMA. However, any contributions to these types of accounts are considered irrevocable, and as I mentioned before, you would lose control of the assets in this type of account once the grandchildren reach the age of majority. You also may miss out on tax deduction that is applicable to your state for 529 plan contributions. Another main advantage of establishing 529s for each of the children is that they are interchangeable and can be passed along to other family member 529s. Say if one receives a scholarship, and if Mary's anything like you, your other two children, then she may certainly be riding along that scholarship path as well. Well, I know we just went over a good amount of information. Do either of you have any questions about these recommendations before we address the next topic in the financial plan? Well, if you do have anything, then we can certainly revisit this topic. Let's now talk about your home ownership coverage.